Hello, my trading friends, and welcome back to Forex Focus, brought to you by IG. Taking a deeper look at the recent downside in the Australian dollar, Aussie crashing back down to new lows on the year, coming off of what was interpreted as a more hawkish FOMC, first FOMC of the year, that is the U.S. Central Bank meeting for the first time in 2024, and that coincided with some dollar strength, U.S. dollar strength, relative to this Australian dollar, as the market interpreted this, at least in the short term. We'll see how it all plays out. It's been changing a lot in the 24-hour aftermath of the meeting, but interpreted as slightly more hawkish than expected and potentially fewer rate cuts, or at least pushed out in time rate cuts. We'll dive deeper on that piece in just a second, but let's get into the price action to start the segment here today, because it was pretty significant. Aussie, one of the weakest of the major pairs against US dollar after this first Fed meeting of the year. And this market moved down to new lows on the year after this meeting on Wednesday. And you can see it's been a roller coaster. Now, not the biggest range in terms of pips, but on a percentage basis, seeing some pretty significant swings here in Aussie, and breaking down below 66 cents and getting right up to 65 is just a couple hundred pips from the low for the last year or so of trading. And so really in vulnerable territory for this Aussie, potential crash territory if one of a couple of things happen. One, you see this US relative strength. Maybe they don't cut as much as the market thought with their interest rates, or the economic data in Australia is weaker than expected, what have you. But also, the elephant in the room that we won't get into today is the close ties to the Chinese economy that's been seeing really rough economic data, and a significant part of Australia's economy tied to China. But let's keep it with the FOMC here, because so much to digest coming out of the no decision on interest rates, but some rhetoric from Powell that was definitely translated as, we're maybe keeping rates higher for longer than you think. And you see here in the statement, not necessarily a surprise, but I think something that traders going into the meeting were looking for, maybe some different type of rhetoric, as Powell comes out and says, we're going to maintain this current target range for the federal funds rate, which is the interest rate that they control, for longer if appropriate. Now, that if appropriate, of course, is staring right at inflation, and they want inflation down at 2%. And right now, depending on where you look, it's in a range of 2.5% to 3% thereabouts, given recent readings. And in his mind, that's not 2%. And traders going into this meeting who thought that a March rate cut might be more likely than not, that's the next FOMC meeting, didn't really like this type of verbiage, because now there's no meeting between now and March. And you look at the odds here of the March meeting cut, and still close to 50-50, but starting to dwindle a little bit, under 50%, around 42%. And this was over 70% a month ago, in favor of the first rate cut coming from the Fed in March. And now it's not, as you can see here, it's not an instance of, they went from the market thinking they were going to cut to they're never going to cut. There's still a chance here in March, and I think a lot of people now eyeing the next meeting after March, which is May 1st, as they really likely to cut then. But the Australian dollar did see some pretty significant downside from this, and the US dollar saw some nice upside, going back to a longer term view of the chart. You can see that even though these cuts are still on the table for March, and yes, maybe they're just pushed out in time, they're not necessarily going away from the rate cutting environment. Powell still said that, we're looking at normalizing these rates lower. Even with that, Aussie hit new lows and really didn't bounce back as well as, say, the euro or the pound, who've been relative outperformers in recent years compared to the Aussie or the Japanese yen. And we'll see, because this is a slippery slope here. Like I say, recent lows around 63, 62 cents, whatever you want to call it there, just a couple hundred pips away. And there will be plenty of data from the U.S., from Australia, but also keep monitoring the Chinese economic data as well, given that close tie and correlation between the Australian and Chinese economies. We'll see if this recent small Aussie crash turns into an all-out collapse to the tune that we saw a couple of years ago, getting down into the 50-cent handle. Not quite there yet, but definitely dwindling away, especially the last month of last year. Really looked like Aussie was going to fight back, maybe get closer to 70 cents than to 60. Not so much here in recent trade, but the client sentiment showing that people are on the long side of this Aussie, and they have been for a little bit here, looking for that bounce back, similar to what we've seen recently in the euro or in the pound or even the Japanese yen, getting a little bit more bounce to it than this Aussie has. We'll see if not only the sentiment is long, but if the actual trading is to the upside. Obviously, client sentiment not a guarantee of where these markets are going, but 71% long Aussie, short USD in this major pair is pretty high here, but only time will tell. We'll get plenty more data from the US and from Australia here to come. And then, of course, in the next 40 to 50 days, we'll find out for sure if it's going to be a March rate cut for the Fed or if they are going to push it out. Keep in mind that when the actual event comes in mid-March, usually we've seen those odds closer to 95 or 100% of one or the other when the event actually comes. So likely to see a lot of price action between now and then, either to the yes rate cut or no rate cut. And obviously that will dictate a lot of the Aussie USD trade. So much more to come, but there you have it on the recent Aussie crash.